Welcome to the Invested Dads Podcast, simplifying financial topics so that you can take action and make your financial situation better. Helping you to understand the current world of financial planning and investments, here are your hosts, Josh Robb and Austin Wilson.
All right. Hey. Welcome back to the Invested Dads Podcast. And a happy Mother's Day week to all the moms out there. I'm going to plug a very special shout out to my mom, Debbie. Thanks for making me who I am today.
Literally.
Yeah,
making
literally.
You who you are today.
She's my mom. Love her. And for all the invested dads out there, don't forget, it's Mother's Day week, so do something special for the mothers in your life.
All right. That's right. Mother's Day's here. And since you did a shout out, I will shout out to my mom, Bev. Thank you for making me me. Seems like a song or something.
It's true. Yeah, you should write a song about that.
But yeah, for Mother's Day, we thought we would do some flowers for Mother's Day.
Aw.
Yeah. Special flowers.
Cute.
Special flowers. And you'll find out in a minute what we're talking about. Today's episode, though, is about asset bubbles. Yep.
Good stuff.
At first, I thought that was like a fart joke, but it's not. Nope. It's a whole other thing.
That's a whole other thing.
But an asset bubble is when the price of something, could be anything, rises above the actual value of what it's worth and above historic values, or one or the other. I mean, it's really just a displacement in pricing of something.
It's like, it's a disconnection between price and value.
Yeah. Example, not real. This is not one of the asset bubbles of the past. Let's say I have bubble gum, and then you could buy it for $1.
Double bubble.
Buy it for $1 at the store, blow the bubbles, have fun, chew it. And all of a sudden, somebody thinks, man, I want to make a new digital bubble currency traded with double bubble on the market. And then all of a sudden, bubble gum's in demand. And now it costs $20 to buy a pack of bubble gum. And it's only costing that because people are buying it, and it goes up in price. And then all of a sudden, people realize, wait a minute, this is bubble gum, this is stupid. And then it drops back down to $1 again, and everybody's back to normal. Well, that time period, that's the bubble. It's like, for a little while, things get disconnected from reality. Is really what happens.
So at some point, bubbles will pop.
Yes, bubbles pop at some point, which to the dissatisfaction of little kids everywhere, bubbles pop, and then
you
it's
think
sad.
You can like blow those things bigger and bigger, and then you just get it all over your face.
Then it's soap in the mouth. How kids are just like eating this stuff. It's so gross.
I mean, I like the flavor of bubble gum.
But not bubbles.
Once every 5 years, I'll have a piece of like double bubble.
Oh, yeah?
That's it. I don't chew gum.
Yeah. Those like bubble gum lose flavor fast.
It does, but think about what is the point in gum?
Breath. I get like cinnamon gum, and I feel like my breath is better.
My breath always smells rosy.
Yeah.
That's
true.
Wife.
Yes.
But gum just seems like a wasted effort.
It's calorie. You burn calories. Look at all the weight you could lose just chewing gum all the time.
Not if it's not sugar-free.
No, that's true.
Then you're just in the hole.
Chewing, just going backwards. But we talked about flowers. So one of the first bubbles ever recorded, actually, based on my limited research, was tulips. So flowers for moms, tulips, which are cool flowers. They bloom pretty early. We have some in our yard.
Did you pay a bubble price for them?
I did not. But what happened, actually, this is way back in the early 1600s. Let's go back a couple years. Tulips first arrived to Europe from Turkey in the late 1500s, like 1590s-ish. And they showed up along with all the other cool exotic stuff that was coming to Europe, and there was a big demand for new imported stuff. So you had like spices and oriental rugs and all that cool stuff. Well, tulips came along with them, right? And back in the day, they were like, talked about how fragile they were, because it took a lot. It took like 12. If you had this like stem, it took like 12 years before they flowered. So it was like this huge thing to have tulips, right? So they arrived, and there was this big demand. So in the late 1620s, early 1630s, there's this demand for tulips because of the rarity. So people started buying the bulbs, planting them, and then being like, "Ooh, look how awesome I am! I have a tulip. I'm pretty important." And so there was the upper class that was doing this, and then in Europe there was, especially in the Netherlands where the Dutch lived, there were what we would call kind of a middle class or an upper middle class, and they kind of saw that and wanted to participate as well because, it's kind of like the thing you see, I like to think I'm a little bit higher socially, economically than I really am, so I'm going to extend myself a little farther. We see that today.
Yeah. It's like buying a Rolex when you really
like the Joneses. I always want to be like the Joneses, a little bit better than I am. So that caused this to get a little bit crazier. But they wanted to own tulips, right? And so it was a status symbol. In fact, at the height of this time period, a rare tulip, because again, there's all different colors of tulips, and then they had this disease actually that went through tulips that caused them to have multicolors, which actually was a positive thing, which made them even more rare.
One with the disease.
Yeah, look at that. They traded for as much as 6 times the average person's annual salary.
Woo!
That's a pretty important Mother's Day gift right there. I got you a flower, Mom. By the way, we have no money for the next 6 years. So that was crazy. They had found, though, that with bulbs and stuff, you could get certain ones that would bloom within a year, so the rarity kind of went away. They weren't as fragile as they thought. And if I'm not mistaken, tulips come back up every year.
True.
So it's kind of this whole, I don't have to replenish my supply type of thing. So by 1938, prices have fallen about 99%.
1938?
Yeah, 1638. What did I say? 1938?
You said 1938.
Whenever. It wasn't that long ago. 1638, prices had fallen 99% or back to normal.
Like a normal price of one flower.
For a flower that only blooms for about 10 days.
That is so funny.
Yeah. So I guarantee you, had I been alive in the 1600s, I would not have fallen for this.
You guarantee? Okay,
guarantee you,
good.
because I actually just got flowers for my wife a couple of days ago, and hopefully she doesn't listen to this episode. But when I was shopping for flowers, I picked the cheapest flowers. Not that but like the type of flowers. Like there's roses, and I know she loves a variety of colors. So I was looking for a variety of colors, but they had like spring flowers, which were just a variety of random flowers, and that was on sale. So I got that. Don't tell her. But the idea was I would not fall for stinking tulips, because flowers to me have zero value in my life.
Frugal
whatsoever.
Josh over here.
Oh man,
he would not.
Flowers and cards. Like, don't get me a card, because cards are horrible. Like, what's the point?
Now, to be fair, recent research has actually suggested that this particular bubble was limited to a smaller number of people. So it was like not crazy widespread.
Right.
It was really, like Josh said, the upper middle class and the wealthy class at that time. So it's an interesting thing, but it really wasn't as big as, maybe some people would make it sound. But it definitely was a bubble, and it's thought that some groups of people built up this incident really to warn investors from getting out of control with other asset classes or other bubbles going down the road.
Looking back on it, was so dumb what they were bidding the price up on, that they were using that as a teaching tool. Yeah. I saw one article, they said it was maybe hundreds of people, like not huge countries getting caught up in this, but just this group of people that were like, in a sense, trying to outdo each other with this thing. Kind of reminded me of like Beanie Babies type of thing.
They're like, well,
I don't think that was really a bubble, but it was kind of it was just such a small, limited thing, but that's kind of the idea.
Moments.
Oh man. So there's
things. So let's talk about a more recent bubble. And I don't even really know. I don't know if it's old enough yet that we can look back and say it was a bubble, but it was definitely bubble-esque in many ways. So think about Bitcoin. Now, there's a specific episode we recorded talking about cryptocurrencies in general. We'll throw that in the show notes. But Bitcoin specifically is the most famous cryptocurrency in general. It's the largest and most well-traded one. So it definitely had some bubble-like movements over the last handful of years. So some days, it'll gain, or it's not some days, but some periods it'll gain 20% here and fall 85% the following year. I remember back in the end of, was it 2017? At the end of 2017, that thing was going crazy. Bitcoin was up, 100 and some percent easy in a year, over 16,000 per Bitcoin, and then pretty much tanked. At the beginning of the next year. So that definitely reminded me of a bubble. And that movement over that time period was speculation as a result of a lot of investors getting caught when the price dropped. So they're like, buy. Everyone, it's going up all the time. Why wouldn't you buy? And then all of a sudden people are like, I don't really know I
want to pay $19,000 for one Bitcoin.
What is a Bitcoin and what does it do? Do I really want to do that? So they started pulling out. When people started pulling out, the price fell, and kind of a lot of people lost their shirts. Now, to be honest, a lot of people...
Their digital shirts. They lost their digital shirts.
Yeah, that's you digitally running around naked. That's not cool. But to be fair, a lot of people made a lot of money too. But it's all about timing. If you time it right, you can do well in a bubble, but most people don't because of greed.
Yep. And that's the thing. Like we talk about with Bitcoin, bubbles don't mean that necessarily whatever the asset was that got appreciated and then depreciated went away. Tulips are still around.
Right.
They're just not priced to an extreme level.
Exactly.
Bitcoin's still around, and it's priced, hard to say relatively, but it's at a more realistic spot now where the average investor says, yeah, that's a fair value for what I perceive it to be at.
And
so that's the thing about bubbles is it can happen to anything, and it can still be a good asset, because we're going to talk about the housing bubble later on, where there's still houses are good to own, but at some point the price may be a little bit more extreme where it should be.
Yeah, it's really all about supply and demand.
Yep.
So everything has a finite amount of supply, and when there's less of something, scarcity's up and prices go up. So it's about supply and demand, but it's really also about underlying fundamentals. And when you talk about these two examples, with Bitcoin and tulips, Bitcoin, the underlying fundamentals are very hard to understand. The quantity is hard to understand, and all of that stuff really tricky. With tulips, it's a tulip.
Yeah, but the underlying value was something new,
Yes.
something that people hadn't seen before, and there was perceived value of like other people will want this new item.
Yeah. So specifically with crypto, there's really not enough regulation and transparency to make them super reliable with understanding how the movements work anyway. They're kind of more speculatory at this point.
And speculation, or in a sense, a lot of people have the FOMO, fear of missing out.
Oh, that's much better.
Yes.
I didn't want to have to check the explicit box on our podcast here.
No.
Thank
So
you.
the idea there, the FOMO, is the idea that, hey, everybody else is gaining all this on whatever the asset is, a tulip or whatever. I want to participate. I'm afraid I'm going to be left behind in this grand thing.
You're going to miss out.
And at some point, I disregard maybe my early warnings, what kept me out in the original spot when I said, it's just a flower. And then now it's like, well, okay, it's just a flower, but, and then I add that but in there, and then whatever follows that is just irrational thoughts, and I go into it, in a sense, against my better judgment. The fear of missing out.
Right. It's like you'll buy in at whatever price because you would just want to ride it up because it's gone up and gone up and gone up. It's not about really what's going on. So, yeah, FOMO is a real thing, and it's driven a lot of these bubbles, and we'll talk about a few more examples here shortly.
All right, but first, I have the dad joke of the week.
Dad joke of the week.
I actually have two.
Dad
and
jokes of the week.
They're both bubble related. All right. You ready, Austin?
Oh, I'm born ready.
Okay. What do you call James Bond when he's in a jacuzzi?
Josh, I do not know.
Bubble 07.
That's awesome.
Yup. Next one. What kind of scientist put bubbles in soda?
Yep, got nothing.
Physicist. Physicist.
Okay, Josh, I'm going to cut you off.
Good times. Bubble jokes.
It's bubble jokes. It's dad joke of the week. Enjoy. So, real life examples of some bubbles other than the ones we talked about. There's been a lot of bubbles in history. So we're going to talk about 4 more here. So, here's one. Remember the .com bubble, Josh?
Yes.
So 99, 2000 time period. So in the late 90s into 2000, investors were crazy about the internet. So really anything with .com in the name or associated with the internet at all, the business just took off, either from its IPO or if it was already publicly traded. The stock prices just took off. It was unbelievable. Investors were getting crazy returns for a few years in these tech companies, and they were just buying and buying and buying and bidding the prices up on them. The problem is that the vast majority of these companies were not actually profitable, and if they were, it was minuscule compared to the prices and the valuations that these companies were trading for. So after some time, this became evident. Tech prices crashed. I mean hard. So the NASDAQ specifically was trading at nearly 4,600 on March 31st, 2000, but closed at less than 1,200 on 9/30 or September 30th, 2002. So yeah, 74% of value in that tech-heavy index gone in a year and a half. Now, it is worth pointing out that as of 12/31/19, the NASDAQ was back up over 650% since that time. So the tech companies that did survived very, very well.
Yeah. And, us being in the financial industry, I look at that and say, yeah, you could see you just got a little carried with stocks. And then look at those stinking tulips and like, who in the world would do that, right?
Yeah.
But it's the same concept. Tech companies, they were new. Like selling on the internet, like selling products on the internet was a new concept to a lot of people. And that was the same idea is, I want to get in on this. It's a new thing. It's awesome. Everybody's going to want this. And then it got carried away.
Yeah. Another example is the housing market in 2007 and 2008. So like we just talked about, throughout the 90s, people in the U.S. were making money hand over fist. The economy was booming. International trade was growing. It was really strong. And technology was becoming huge. So people were getting big raises every year. They were buying new cars and bling-bling watches and lavish vacations. Oh, and a lot of house. They were buying houses like never before. So they were talking, we're talking houses in size. They were buying bigger houses and money. They were buying more expensive houses. So housing, it was booming in the 90s and into the 2000s for sure. And this was made easy by greedy banks extending large mortgages to almost anyone with a paycheck. So like people working at, Taco Bell were buying huge homes. Now, part of this was part of this was
Grande.
With their what?
They were Grande.
They were the Verde Grande. Yeah. That's a green large. That's not cool. But what happened was, during the dot-com bubble we just talked about, Alan Greenspan, the Fed chair, cut rates to kind of stave off this dot-com bubble and kind of reintroduce some stimulus and some growth into specifically the stock market at that point. And so what that did was it took short-term interest rates down, which took mortgage interest rates down, and a lot of people got hung out to dry when they got an adjustable rate mortgage, right?
Yep. Yeah, and part of that too was during the early 2000s to mid 2000s, there was a lot of push for more people to be homeowners. The idea, the American dream of owning your home and blah, 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 that was pushed to say not enough people are able to experience that dream. Let's make it easier. And so they adjusted the lending procedures and kind of the criteria needed for accepting a loan. They were a little more lenient, and that caused some problems because there was less scrutiny on who was getting these loans.
So just like the tech bubble that we just talked about, as people were getting mortgages and buying homes, which admittedly were much more home and much more expensive than they really should have been able to afford, housing prices were bid up because there was a lot more demand for people to be able to buy homes and to have a house. So the problem was that the economy, which it was strong and growing at that time, those economies that are strong and growing very rapidly, they don't last forever, right? So when things start to slow down and people start having a little less money in their pockets, maybe comparatively speaking anyway, they're overextended on the house that they got approved for, and their mortgage payment becomes very, very large compared to what they're taking home, and they foreclose on their home, and then there's a lot of houses on the market, and all of a sudden the prices crashed.
Yep. And a lot of it, if you think about what you mentioned, the adjustable rate mortgage, what you do is you start out with a lower interest rate for a couple of years, maybe 5 years, and then after 5 years, it readjusts, usually upwards, to a higher rate. And so that a lot of people were buying these with nothing down, so they had no equity in the home, with the thought that in 5 years, when this rate's going to adjust, I'll either have equity so I can refinance, or I'll sell it for a profit and move on to the next one. Well, what happened a lot of times was this lower payment barely fit into their budget, and then now that it's adjusting upwards, they can't afford the new payment. They can't afford to sell it because they owe more money than it's worth, and so they were stuck. A lot of people just had to walk away.
And that's what caused housing prices to just drop drastically. So, hindsight's 20/20. But looking back at these bubbles ended up being the ultimate buying time if you have some dry powder or cash laying around. The problem is that most people don't just sit on a bunch of cash. Much of it is being used for day-to-day expenses, or it's already invested in the market or whatever. So it's really, really tough to time those things. But if you did, you could have bought into tech for pennies on the dollar and become very, very wealthy over time. Or you could have bought your home for half price. Who knows?
Yep. Yeah, that's a lot of investing. There's timing involved, and there's smart timing in that you want to avoid these extremes. But in general, most people don't have the ability to go all in on the low or be able to identify that low point.
Exactly.
Because again, the fear of missing out on the high point, but then at the low point, the worry that is there still more to come?
Yep.
And then you kind of wait to feel better about it, and then it's too late.
Exactly.
So another example is the stock market crash in the late 1920s. And so the Roaring 20s, that's, I wasn't around for that, but apparently it was roaring. And so that had a good impact on the stock market. From 1920 to 1929, in fact, the stock market was up 670% during that time. Great. Awesome. In 1929, though, and this is what's crazy, shortly before the crash, an economist, Irving Fisher, said, stock prices have reached what looks like a permanently high plateau. In other words, we're never going down from here, which should always be a warning sign.
Up.
Yeah, plateau. I guess maybe they were just pretty. This is it. We're good. And then in October, the market hit a new high in September 3rd or something right around there. Then in October, they had what was called Black Thursday. The market at the opening bell lost 11%. So can you imagine that if tomorrow morning stock market opens and immediately drops 11%?
In a day.
Not in a day.
No, at open.
At opening bell. Like we're talking 9:30 in the morning.
Right.
And so back in the 20s, they had the stock ticker.
Yeah.
Right. And ticker tape. They actually literally had a ticker tape, like physically tape that would go through all these stuff. Because of this huge onslaught of selling that happened from this, the ticker tape was taking so long to spit out all this stuff that everything was delayed. And so the average person actually that was not on the trading floor did not even realize what was happening because it was so delayed on this tape printing out all the crap that it had to do. And so what then happened was a bunch of leading bankers got together and they said, okay, we've done this in the past. We are actually going to come in with all of our bank's assets and wealth and start buying above what the asking price is for some of these large blue chip stocks.
Right.
The idea being is kind of alleviating the panic. So, if whatever a big blue chip stock is paying, let's say $10 and it's dropping in price, it started at 15, now it's down to 10. They'll say, I'll buy it for 12. And so it kind of puts this floor and it makes, 12. Okay. They're not too worried about it. Maybe I'm okay with it, and they're kind of slowing down that drop.
And it still did not stop the entire drop.
Well, so from the end of the day, it was only down 6. So they brought it back up on the end of that day. But then Black Monday happened. So that was Thursday. Then Black Monday happened where the market lost 13%. Then we had Black Tuesday where the market lost another 12%. So that was fun.
That's a bad week.
But overall, the market lost 89%, almost 90% of value during that time frame. And so this happened in 1929.
Yeah.
The market did not make a new high until November of 1954.
That is a long bear market.
That's a long recovery during that time frame. So that was a big crash. And when we talk about bubble, it was the market in general. And it wasn't one particular asset class that was causing it, but the market in general had this bubble effect, partly because fewer people were actually investing in stocks during that time frame. So in a sense, it was its own smaller asset class from, if you look at it from an old U.S. economic thing. A lot of people own more farmland, things like that. Yep. Yeah, but the market cap was like, I don't know, $1.5 trillion for the top grouping of stocks. They lost about $1 trillion in assets. So, they lost a lot of money.
Yeah.
So it was pretty rough. Another example, and this is what was, and I was looking at a couple articles for this, they were kind of determining to be kind of one of the biggest bubbles of all time. And the reason for that is kind of the size, the scope, and the impact of this. And so I'm talking about Japan. So in 1986, Japan kind of went on this big run. So from 1986 to 1991, Japan had a growth in the real estate and in the stock market. They were doing well. In fact, Ben Carlson, who we actually did a cool interview with a while back, he wrote an article about this bubble in particular, and we'll link it in the show notes. But he said, at the peak, the Japanese Imperial Palace, so that building, property, was considered to be worth more than all the real estate in California combined, or Canada. So imagine that. That's how much asset prices happened in Japan, that the Imperial Palace in Japan.
Was that like the Capitol building?
Yeah. It's where like the emperor lived. Was worth more than all the real estate in California or Canada. So there's value there.
Fun fact, the Japanese Capitol building is called the Diet Building, I believe.
Oh, yeah?
Yeah. I've been there.
It's weird.
I don't know why it's called that.
Weird fact. Thank you.
Totally weird sidebar fact. But anyway, Josh.
Also during that time, the stock market in Japan had grown 1,000% or 10x.
In 5 years.
In 1986 to 1991.
Yeah. Wow.
Good growth.
That is pretty good.
And so Ben Carlson in the article said, if you had $100,000 to invest in 1970, so he's just using some time frames to show this growth, 1970, by 1989, you would have had $5.7 million on that $100,000 investment.
That's pretty good.
That's awesome.
That is pretty good.
Now, post the crash, and we'll talk about that when it dropped from 1990 to 2015, your $100,000 investment, if you would have started in 1990, would actually be worth $90,400. So you actually would have lost
money.
$9,600.
Yeah.
And so you can see the difference between those two time frames.
Yep.
Also, in Japan, there were 20 golf clubs that cost $1 million to join the golf club.
You're not talking about like the actual,
Not to buy the property.
not the clubs themselves, but to be,
Like if I wanted to be a member of this golf club,
yeah.
the membership fee was $1 million to join it.
That's a pricey one.
Yeah.
I thought we were talking about $1 million actual golf clubs, like a
No,
driver
not
was
like
$1
clubs
million.
itself, but like the club of the golf resort.
That
The membership there is,
and that's in 1980 some dollars.
yeah, it's crazy.
That's a lot of money.
Yeah, but all of a sudden people realize, okay, going crazy. Oh, total Japanese property. So I talked about the Imperial Palace, what it was worth. If you look at Japan, which from a country size, it's not as
Very
big as the United
small,
States.
right.
Not very big. Their value of all their property was 4 times more valuable than the real estate in the U.S.
Woo-wee.
So you can see how extreme things got there. So needless to say, there was a big crash. Japan took a beating, and they lost about 80% of the stock market value, and then overall their real estate value, everything. They went into a very rough period of time, and in fact, they have yet to make new all-time highs from that peak. So
That is crazy.
yeah, they're still struggling 30 plus years later. So it's interesting, but you can see the long-term impact of these bubbles if they're allowed to play out to the extremes.
Now, it sounds like asset bubbles can really happen in any time, right? So, like, think about it in a bull or a bear market. In a bull market, so things are going up all the time, you really get FOMO. So you have that fear of missing out going up. In a bear market, you can become more aggressive. You feel like, so in a bear market, you become overly aggressive or have to get creative to make up for lost time or a down account or whatever. And so you can really get it on both sides, get these bubble impacts on both sides of the way that the overall trend is moving. And a lot of really smart people have gotten caught up in these over time. But the biggest thing to remember is not to let FOMO drive your decisions. So don't have that fear of missing out. You just have to stick to the plan. And if something doesn't make sense, you can't explain the reason for the rapid price movement, it's really not probably worth taking a risk on and investing in.
Yeah, and the key is to know wealth takes time. To do it right, to do it without taking those crazy risks that have that high probability of success or failure, with those extremes, it takes time to build wealth. Consistency is key.
Right.
Get a plan, stick to it, periodically be adding your money, especially while you're working, talk about that, 401k, those payroll deductions. Make sure you're doing the steps yourself and then let the market do what historically it has done and to grow faster than inflation. And that's really the goal. And so we advise everybody out there, focus on those long-term goals, build a sustainable plan, and then make sure you have an advisor there to help, because hopefully there'll be people there to help you, to discourage you from looking into those things. And there were advisors got caught up in these as well. They're not immune, but hopefully with a couple heads together, you can say, okay, realistically, are we thinking rationally on this? Or at least, am I putting too much of my assets in a venture that could not turn out? Because again, we've talked about it before. Maybe it's fun to try things or take a little risk. If you can match that in your portfolio and you have the tolerance for it, great. But make sure it's not going to hurt your long-term goals by taking those risks in a venture that, even in starting a business, there's risk involved. Like, what will that do to my long-term chances?
So to make sure that you kind of keep track and keep on the path with your long-term goals, just don't forget, we've got a free gift for you on our website, a brief list of 8 timeless principles of investing. These are overarching themes meant to keep you on track to meet those goals over time. So check it out. It's on our website.
Also, if you want to help us, subscribing to our podcast is great. We love that you'll be able to get the most recent updates every Thursday when it comes out. If you could leave us a review, that'd be awesome. And then we love answering questions and doing podcasts on things you'd like to hear about.
True story.
So if you have any ideas or have a question, reach out to us at hello@theinvesteddads.com.
So don't forget, it's Mother's Day week. So get your mom a card or flowers or a tulip even, and get your wife something from your kids.
That's right. Get all the moms in your life something.
Exactly. So thanks for being here. We appreciate it.
Yep, we'll talk to you next time.
Bye.
Thank you for listening to the Invested Dads podcast. This episode has ended, but your journey towards a better financial future doesn't have to. Head over to theinvesteddads.com to access all the links and resources mentioned in today's show. If you enjoyed this episode and we had a positive impact on your life, leave us a review, click subscribe, and don't miss the next episode. Josh Robb and Austin Wilson work for Hicks & Zerker Capital Management. All opinions expressed by Josh, Austin, or any podcast guests are solely their own opinions and do not reflect the opinions of Hicks & Zerker Capital Management. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Hicks & Zerker Capital Management may maintain positions in the securities discussed in this podcast. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Past performance may not be indicative of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses which would reduce returns. Securities investing involves risk, including the potential for loss of principal. There is no assurance that any investment plan or strategy will be successful.